Welcome back to Talkpoint. Wall Street saw a major boost today as the Dow Jones Industrial Average surged 420 points. Investors are cheering after strong retail sales data and signs that inflation is slowing, giving renewed confidence in the US economy. Tonight, we will break down what drove the market rally, the economic indicators behind it, and what this could mean for investors and everyday Americans. The Dow Jones gained 420 points, closing at its highest level in over 2 weeks. The S&P 500 and Nasdaq also rose sharply, fueled by optimism over consumer spending and easing price pressures. Analysts say the surge reflects renewed investors' confidence that the Federal Reserve may not need to hike interest rates aggressively in the coming months, allowing business and households some breathing room. Stock market tickers, trading floors footage, graphs showing index movement. Today's rally was largely driven by better than expected retail sales numbers in July. US retail sales rose 0.8%, surpassing forecasts to 0.5%. Consumers spend more than everything from electronics to dining out, signaling that the economy remains resilient despite concerns about inflation and rising interest rates. Retail analysts say that demonstrate that Americans continue to feel confident in their personal finance. Shoppers in malls, cash registers, online shopping graphics. Adding to the positive sentiment, new data shows that inflation is slowing. The consumer price index for July increased 2.6%, down from 3.1% in June. Slower inflation eases pressure on the Federal Reserve to raise interest rates aggressively, which is good news for investors, homeowners with mortgages, and business looking to borrow or expand. Economists say this combination of strong retail sales and easing inflation creates a favorable environment for continued economic growth. Inflation charts, CPI data graphics, grocery store, and gas price visuals. Certain sectors led today's gain. Retail and consumer discretionary stocks surged as strong spending reports boosted confidence. Technology stocks also benefited, with major companies posting moderate gains and renewed investor optimism. Meanwhile, banking and financial stocks rose slightly as expectations for slower interest rate hikes improved lending outlooks. Energy stocks, however, saw mixed performance, reflecting ongoing volatility in oil and gas markets. Major company logos, stock performance charts, tech gadgets, and energy market visuals. Market experts caution that while today's rally is encouraging, investors should remain watchful. Economic growth could face headwinds from global uncertainty, Federal Reserve policy changes, or unexpected market shocks. Morgan Hayes, a senior market strategist, told Talkpoint, this rally reflects confidence in the short term, but investors should remain diversified and cautious as volatility can return quickly. Analyst interviews, charts showing market volatility, trading floor commentary. For everyday Americans, the market rally may signal positive economic trends, stronger consumer spending, stable price, and potentially lower borrowing cost. Investors may see opportunities in equities, but financial advisors stress balancing risk and keeping long-term strategies in mind. For retailers and those relying on investment income, this uptick may provide short-term relief but does not eliminate the need for careful portfolio management. Investor check-in portfolios, people shopping, personal finance graphics. Wall Street gains today show that optimism is returning to the markets, but economic conditions may remain fluid. Analysts will be closely closely monitoring upcoming federalism meetings, inflation reports, and corporate earnings to see if the rally can sustain itself. We will continue to track the markets and bring you updates on key indicators that could affect your investments and the broader US economy. You have been watching Talkpoint. Like, subscribe, and turn on notification to stay informed on the latest financial news and market developments. Thanks for joining us, and we will see you in the next update.